So, when you open up your brokerage app to check on a regional utility operating out of Kansas and Missouri, you probably aren't bracing yourself for some kind of massive revenue shock, right?
Right, yeah. You generally don't expect fireworks from the Midwest power grid.
Exactly. I mean, you hold these kinds of equities for the dividend yield, the low beta, the stability. But if you look at the Q1 2026 print from Evergy Inc., that's ticker EVRG, you're going to see numbers that, well, they look suspiciously like an aggressive, high-growth tech company.
Yeah, it really forces a complete recalibration of how we model a regional power provider these days.
It totally does. Welcome, everyone, to another Talk Tickers Deep Dive. The mission today is pretty simple. We are taking the transcript from Evergy's Q1 2026 earnings call, and we're going to translate all that Wall Street jargon into plain English.
Because honestly, there is a lot of jargon in this.
Oh, tons. But we're going to break it down, make it actionable, and show you why a supposedly sleepy utility is suddenly putting up these insane numbers. So let's just jump right into it. The headline numbers.
Let's lay out the raw data first. So we are looking at a Q1 adjusted EPS earnings per share of 69 cents.
Which, just for context, was what last year?
It was 55 cents in the first quarter of 2025.
Okay, so wait. That's a 25% jump in EPS year over year.
Exactly, 25%.
That is just, that's what caught my attention immediately. For a highly regulated utility, a 25% variance is practically unheard of.
It's massive.
Right. Like usually when a power company posts a number like that, it means, there was some freak blizzard and everyone had their electric heat cranked to maximum for 3 straight months.
Right, the weather anomaly.
Yeah. Was this just a weather fluke? Because looking at the weather data for the Midwest earlier this year, it was actually, it was incredibly mild.
Yeah, and that's the crazy part. The weather was actually a massive drag on the quarter.
Oh, really?
Yeah, in utility modeling, everything revolves around heating degree days in the winter and, cooling degree days in the summer. And because the Midwest experienced an unseasonably warm winter, those heating degree days just plummeted. People simply weren't turning on their heat.
So they were selling less power for heating.
Exactly. That mild weather actually resulted in a 6 cent per share penalty compared to Evergy's internal budget. So they essentially started the quarter in a hole.
Okay, wait. So if they lost 6 cents to a warm winter, the math to get to a 25% year-over-year increase gets even steeper.
Oh, it gets much steeper.
Where is that margin actually coming from then?
Well, we have to look at the regulatory mechanisms first. So they picked up 15 cents in EPS through the recovery of new retail rates and FERC regulated infrastructure investments.
Okay, let's get into the weeds on that rate recovery for a second.
Sure.
Because I think a lot of people misunderstand the lag time that's inherent in utility capital expenditures.
Oh, absolutely. It's a very specific accounting quirk.
Right. So when Evergy reports a 15-cent bump from FERC recovery in Q1 2026, we are really seeing the financial manifestation of physical grid investments that they made months or even years prior.
Correct. Yes, exactly. That is the core dynamic of the regulated utility model.
Okay.
When Evergy builds, say, a new high voltage transmission line, or they upgrade a substation to handle bidirectional flow.
They're paying for that up front.
Exactly. They deploy their own capital. They don't just immediately start charging customers for it the next day.
Right. They can't just hike the rates.
No. They have to file a rate case with FERC or their state commissions. Then they go through this lengthy audit process to prove those investments were, prudent and necessary for grid reliability.
Sounds tedious.
It is. And only then are they allowed to adjust the rates to earn their authorized return on equity.
Got it.
So that 15-cent boost, that's really just the delayed gratification of previous capital deployment finally hitting the income statement.
Right. But deploying all that capital isn't free. They had to issue debt to build those substations, right? And they have to maintain them.
Which brings us to the offsetting costs.
Oh, okay.
Yeah. The higher operations and maintenance costs O&M, combined with increased depreciation on those new assets, plus the net interest expense from the debt you just mentioned, all of that created a 10-cent drag on EPS.
Okay, let me just summarize the math here so we don't lose anyone.
Go for it.
So we are down 6 cents from the weather, up 15 cents from rate recovery, and down 10 cents from O&M and interest expense.
Right.
So essentially, the traditional utility levers are effectively canceling each other out. Like, that leaves us slightly negative, actually.
Yep, pretty much flat or slightly down.
I know there's like a 9-cent positive variance buried in the transcript from some company-owned life insurance proceeds and a lower tax rate.
Yeah, bit of an accounting benefit there.
Right, but that still doesn't explain the massive beat. Like, the core operations must have crushed it somewhere else.
And that's exactly it. The true engine of that 25% jump, the thing that honestly changes the entire thesis for holding this stock, is the structural load growth.
Okay, load growth. Break that down.
So load is just industry speak for overall electricity demand on the grid.
Okay.
When we isolate their weather normalized demand, meaning we strip out the noise of that super mild winter, Evergy's overall system demand grew by 4.7%.
Wow. Okay, just for context for you listening, legacy utilities usually model their baseline load growth at, what, maybe 0.5% to 1% a year?
Yeah, historically, 1% is considered a good year.
So hitting 4.7% is just blistering.
It's massive. And if you look at the breakdown by customer class, residential demand grew 3.3%, commercial grew 3.3%.
Which are solid numbers on their own.
Very solid. But the industrial segment, it completely decoupled from historical norms.
How high did it go?
Industrial demand rocketed 10.1% higher in a single quarter.
Wait, 10.1%? What physical infrastructure is drawing that much baseload power in the Kansas and Missouri footprint? Like, what is plugging into the wall over there?
There are two distinct catalysts driving this. And honestly, they represent the two biggest macro trends in the global economy right now.
Okay, I'm hooked. What's the first one?
First, the Panasonic EV battery manufacturing plant located in their territory is aggressively ramping up production right now.
Okay. Battery manufacturing. I know that's notoriously power intensive, but break down why it draws so much more load than like traditional heavy manufacturing, like a car assembly line or something.
Yeah, so think about the physics of creating a lithium-ion cell. It isn't just an assembly line where robots are, bolting metal frames together.
Right.
It is a highly sensitive, continuous chemical process. You have these massive electrode drying ovens that have to run at extreme temperatures.
And I'm assuming they can't just be turned off at the end of a shift.
Exactly. They run continuously to evaporate solvents. You have cathode baking processes. And perhaps the biggest draw, the entire facility has to operate under incredibly strict environmental controls.
Oh, like clean rooms?
Yes. The clean rooms require massive industrial-scale HVAC systems running 24/7 to maintain near-zero humidity levels.
Because moisture ruins the battery chemistry.
Exactly. Moisture is the enemy here. So that continuous, unrelenting power draw, that is a dream scenario for a utility providing baseload power.
That makes total sense. So Panasonic is a huge chunk of it. And what's the second catalyst?
A very large new data center that energized in March.
Data centers, of course.
Yep. And it actually came online a couple of months ahead of schedule. Just the Panasonic plant and this newly energized data center alone, just those two things, added 2 cents to the EPS in the quarter.
That's wild. So the industrial demand is so heavy and so constant that it is essentially overriding the seasonal weather risks that usually dictate a utility's quarterly performance. Like, a mild winter used to mean a guaranteed miss on earnings. Now, the structural power draw from these massive mega facilities is just filling that gap entirely.
It completely changes the risk profile of their revenue stream. And what we saw in Q1, it's really just the tip of the spear.
What do you mean?
Well, the most critical part of this earnings call wasn't even the backward-looking Q1 beat. It was management's forward guidance regarding their electric service agreements, their ESAs.
Okay, the ESAs. What was the big announcement there?
They announced the signing of a 5th major ESA with a new data center developer.
Okay, 5th one. Did they name the developer?
No, they kept the exact name under wraps. But they did specify that it's an investment-grade developer working with hyperscaler off-takers.
So we're talking the big boys, Google, Microsoft, Meta.
Exactly. And beyond signing that 5th contract, they also announced amendments to 2 previously signed contracts.
Oh, why amend them?
Because those hyperscalers realized their initial power estimates were way too low. They need more capacity.
Let's quantify that capacity because the numbers thrown around on this call, they are just staggering.
Yeah, they are. Evergy is projecting that the steady-state peak demand from just this specific cluster of new large tech customers will hit 3 gigawatts.
3 gigawatts?
Yes. And by the end of 2030, they expect to be serving 2.25 gigawatts of capacity exclusively for these mega clients.
Wow.
Which, by the way, is a 500 megawatt upward revision from the projection they gave Wall Street just 3 months prior.
Wait, adding 500 megawatts to a 2030 projection in a single quarter.
Yeah, that's how fast it's moving.
That just shows how rapidly the AI hardware deployment cycle is moving right now. But let's just pause and think about the physical reality of a 3 gigawatt load for a second.
It's hard to visualize.
It is. Because we hear gigawatts thrown around so casually in the financial media, but integrating that much demand into a regional grid, that has to be an engineering nightmare.
Oh, absolutely. It requires a massive restructuring of their transmission architecture. I mean, you can't just plug a 3 gigawatt data center cluster into the existing grid like a toaster.
Right, just run an extension cord.
Exactly, no.
Yeah.
You are talking about building dedicated high voltage substations. You need incredibly massive step-down transformers.
Which I read are facing huge supply chain issues.
Oh, terrible issues.
Yeah.
They currently have lead times stretching out 3 to 4 years globally.
Wow.
And most importantly, you need firm, dispatchable baseload generation.
So not just wind and solar.
Right. Solar and wind are great for the overall grid mix, but they are intermittent. AI training models require 100% uptime.
Right. If the wind stops blowing in Kansas, the NVIDIA H100 clusters can't just shut down mid-training.
Yeah, exactly.
Which means Evergy has to commit staggering amounts of capital to build out this physical infrastructure.
Yep.
And looking at their updated guidance, I mean, they fully intend to. They actually raised their retail load CAGR estimate, that's compound annual growth rate, through 2030 from 6% to between 7 and 8%.
Which is phenomenal growth.
It is. And that flows directly into their EPS growth, which they now expect to exceed 8% annually starting in 2028. But to me, the most important metric for understanding the capital intensity here is their rate base CAGR.
Right, the rate base.
Yeah, they bumped that up to approximately 12%.
Yeah, let's unpack that, because that rate-based expansion is essentially the pure financial translation of all those transformers, transmission lines, and generation assets we just talked about.
So more infrastructure equals a bigger rate base.
Exactly. They are accelerating their capital deployment to build the required infrastructure, and that expands the base of physical assets that they are legally permitted to earn a return on.
Okay, but this introduces the most critical risk factor for anyone holding this stock.
The debt load.
Yes. Their capital investment plan is sitting at $21.6 billion.
It's a huge number.
It's massive. They are taking on immense debt and committing insane resources to build power infrastructure for tech companies that operate in highly volatile, hyper-competitive markets.
Sure.
So what happens to the math if there's an AI hardware glut in 4 years?
Right.
Or what if compute efficiency improves so drastically that these hyperscalers just decide, you know what, we don't need these massive Kansas facilities anymore?
It's a very real concern.
If a 500 megawatt data center goes dark, you have a multi-billion-dollar stranded asset on your hands. So how are investors and, frankly, local everyday electricity customers protected from footing the bill for an empty, deserted power plant?
That is the multi-billion-dollar question.
Yeah.
And the regulatory mechanism designed to insulate the grid from that exact scenario is Evergy's Large Load Power Service Tariff,
Yeah.
the LLPS.
Okay, the LLPS. Break down the mechanics of this tariff. How does a tariff prevent a stranded asset?
Well, it's all about the structure of the contract. Under the LLPS tariff, these hyperscalers are not just buying bulk electricity on the spot market day by day.
They're locking in.
Yes, they are signing 16 to 17-year binding agreements.
Wow. 16 years.
Right. And embedded within these agreements are incredibly strict minimum monthly bill requirements.
Oh, so it functions somewhat like a commercial gym membership.
That's a great way to put it, actually.
Like, sign the long-term contract, and you are paying that monthly fee whether you are using the equipment every day to get shredded or you never step foot in the building.
That's the exact financial mechanism. The tariff is designed so that the tech companies pay premium rates that cover not only their marginal power usage, but also their proportional share of the massive capital upgrades required to plug them into the grid.
Okay, I see.
So whether that data center is running AI inference models at 100% utilization, or scaling back to 30%, or completely shutting down the investment-grade parent company, the Googles, the Metas, whoever, they are legally obligated to pay that massive minimum bill to Evergy for the next decade and a half.
Okay, that drastically alters the risk profile because the capital risk is essentially being shifted off Evergy's balance sheet and off the backs of the local residential ratepayers directly onto the balance sheets of these trillion-dollar tech conglomerates.
Exactly. And that protection for the residential ratepayer is absolutely crucial.
Because of the regulators, right?
Exactly. State utility commissions will simply not approve these massive industrial contracts if it means local families are going to see their power bills double just to subsidize AI data centers.
Right, that would be a political nightmare.
A total disaster. Evergy knows this, which is why they also brought forward a major regulatory win on this call regarding their nuclear fleet.
Ah, right, the deferred nuclear production tax credits.
Yes. They secured a unanimous agreement from the Kansas Corporation Commission to flow over $100 million a year in federal nuclear production tax credits back to customers over a 3-year period.
Okay, wait, how does that tax credit mechanism actually suppress local rates? Like, where is that money coming from?
So these credits largely stem from the Inflation Reduction Act.
Okay.
They provide a direct financial incentive for producing zero-carbon baseload power from existing nuclear plants.
Which Evergy has.
Right. But instead of Evergy retaining that massive financial benefit to pad their own bottom line, they are routing it directly to the ratepayer base as a bill credit.
Oh, wow. So it directly lowers the customer's bill.
Exactly. When you combine that $100 million annual buffer with the premium rates being paid by the hyperscalers under the LLPS tariff, it creates a massive downward pressure on local rates.
Which keeps everyone happy.
Evergy actually noted on the call that their overall rates today are only about 5.1% cumulatively higher than they were back in 2017.
That is astonishingly far below the broader rate of inflation over that same period.
Absolutely.
So they have managed to structurally separate the massive capital costs of the AI boom from the everyday consumer. They're keeping the regulators happy while guaranteeing their revenue through 16-year take-or-pay contracts.
It really is a masterclass in regulatory maneuvering.
It is.
And it brings us to the core actionable thesis for this stock. If you review the results from this Q1 call, the outlook is undeniably bullish. We're not just analyzing a solid earnings beat here. We are watching the real-time transformation of a company's fundamental growth profile.
Okay, so let's segment the actionable takeaways for you listening. Let's say you already hold EVRG in your portfolio and, you bought it a few years ago purely as a defensive yield-generating utility play. How should this earnings call change your positioning?
I'd say it hardens the thesis into a high conviction hold.
Okay, why?
Primarily because of the strengthening balance sheet metrics. In the utility sector, credit rating agencies and institutional investors absolutely obsess over the FFO to debt ratio.
That's funds from operations to debt, right?
Yes. It evaluates how much operating cash flow a utility is generating relative to the massive debt loads they carry to fund all this infrastructure.
Right, because if that ratio slips, their cost of capital skyrockets, which makes those multi-billion-dollar grid upgrades prohibitively expensive.
Exactly. It's the most critical health metric. Now, prior to this quarter, Evergy was forecasting an FFO to debt ratio hovering around 14%.
Right.
But modeling in the guaranteed revenue floors from these newly signed and amended LLPS contracts, they now project that metric strengthening to a range of 14 to 15% from 2026 through 2028.
Because the cash flow is guaranteed by the tech giants.
Right, and it will naturally strengthen even further as these massive data centers hit their peak steady-state loads toward the end of the decade.
Got it.
You have long-term guaranteed cash flow visibility backed by the most highly capitalized companies in the world. You do not liquidate a utility position at the exact inflection point where its structural demand effectively doubles.
No, you absolutely don't. But what if you were on the outside looking in? Like, let's say you've watched the massive run-up in AI software and semiconductor valuations, and you feel like the entry point for the obvious tech plays like NVIDIA or Microsoft is simply too rich right now.
Then you need to evaluate Evergy through an entirely different lens. You cannot analyze this purely as a defensive yield play anymore. It is essentially a backdoor infrastructure play on the global expansion of artificial intelligence.
It's the ultimate derivative play.
Exactly.
Like, you don't have to pick the winning large language model. You don't have to guess which tech CEO is going to win the AI race. You just own the baseload power required to train all of their models.
Right. Data center developers are currently engaged in this massive land grab across the country. But land is completely useless without extreme quantities of water for cooling and highly reliable non-intermittent power.
Which Evergy provides.
Exactly. The Midwest has those physical resources. And more importantly, as we just discussed, Evergy has proven they have the regulatory framework in place to monetize those resources without drawing the ire of state utility commissions.
That's a huge moat.
It is. And from a capital funding perspective, they are in a very clean position.
Yeah, I want to ask about that. How are they paying for all this if not just debt?
Well, they stated they plan to fund their capital program with roughly 40 to 50% equity. But, crucially, they have no intention of doing dilutive block issuances.
Oh, that's good news for shareholders.
Very good news. They can fulfill their equity needs entirely through their existing at-the-market program.
So they just trickle it out.
Right. Nice and steady.
So the mechanics are all aligned here. You have a massive upward revision in load growth. You've got ironclad 16-year revenue floors and a non-dilutive capital funding plan.
Yep.
But, there was one detail buried near the very end of the Q&A session that completely recontextualizes the scale of what is happening here.
Oh, I know exactly what you're talking about.
Right. We spent all this time breaking down the 3 gigawatts of demand stemming from the 5 contracts they've already signed.
Yeah, the active ESAs.
But the prospective pipeline.
It's nuts.
It is. The CEO casually mentioned that their active pipeline of prospective customers currently waiting to secure power agreements totals well over 10 additional gigawatts.
10 gigawatts of demand. Just waiting in the queue.
It's unfathomable.
To put that in perspective for you, that is the equivalent power draw of 10 times the capacity of a standard nuclear reactor, just sitting there waiting for grid access.
Which really forces you to ask a very serious question about the future economics of this sector.
Definitely.
What happens to the pricing power, the regulatory leverage, and the ultimate terminal value of a regional utility when it possesses a commodity firm base load power that trillion-dollar technology companies are literally queuing up to buy at premium rates?
The dynamic completely shifts.
Exactly. When demand outstrips physical grid capacity by a factor of 3 or 4 to 1, the leverage completely flips in favor of the utility. It's something to really mull over as you look at your portfolio this week. So keep pulling on that thread, keep analyzing the infrastructure behind the algorithms, and we will see you on the next deep dive.
Thanks for joining us.